I'm Martin King, property analyst at Edison Investment Research, and I'm delighted to be in Athens today to talk with Dimitris Papoulis, CEO of TRESTATES. Dimitris has been CEO since 2022 and has overseen a period of very strong growth in the company. We're going to talk about its strategy, that growth, and the further opportunities. Dimitris, good to see you.
Martin, great to be with you today, and thank you for the interview.
Dimitris, can we start, for investors who might not be familiar with the company, I'm thinking particularly investors outside of Greece, could you give an overview of what TRESTATES is?
So TRESTATES is a specialized real estate investment company focusing in retail parks and logistics. It's focused on the omni-channel retail, combining end-to-end solutions for modern retail. And since its inception, it has grown into a platform of 600 million euros worth of assets in an underserved segment of the market.
You talked about retail parks as being an underserved sector. Can you also talk about the attraction of retail parks to consumers and what drives that interest for investors?
So retail parks are all about convenience, accessibility, and value. They are focused on serving necessity shopping, and that differentiates the model in many ways against discretionary income destinations. We are anchored normally by supermarkets, home furnishings, electronics, needs that are resilient towards various economic cycles. On top of that, Greece is very underserved on the specific sector, offering important opportunities of growth and returns.
Dimitris, you talked about having built a platform of 600 million in assets. How fast has that growth been?
TRESTATES has delivered a compound annual growth of more than 30% over the past 5 years. Our funds from operation have grown from 9 million euros to 22 million euros over the last 3 years, which represent one of the most aggressive growth rates among European real estate companies.
And I know you want to talk about the very strong growth opportunities that you see going forward, but before that, can we just take a step back and talk about the creation of TRESTATES?
So TRESTATES was established through the contribution and spin-off of 7 big assets of Papoulis Group, one of Greece's prominent retail groups. These assets formed the foundation of the creation of TRESTATES, but as time evolved, the company has increased its shareholder base through private placement and IPOs.
So Papoulis was very important when TRESTATES was formed, and it's still important, but the company has grown a lot since then. Can you talk about how the shareholder base has broadened?
Papoulis is very important and will be very important for TRESTATES. The stake of the company from 99% during its inception today is at 47% through a series of private placements and the IPO. 13% of the company is owned by the Vasilakis family through Auto Hellas Group, and 8% of the company is owned through Latsko family office, the family office of Miss Mariana Latsis. 31% of the company is free floating, and approximately 2% belongs to the management of the company. So this evolution presents the determination of Papoulis Group to create a real multi-shareholder base real estate investment company with specialization coming from the DNA of its founder.
Can I get you to talk about the future growth prospects, both organic and the prospects for future development, and also how much visibility you've got about that?
Yes, well, we have a strong track record of producing solid organic growth, and this is a main result of our specialization. The combination of experience and the strategic relationship with the majority of international and local value retailers is giving us the opportunity to continuously enhance the performance of our assets, including our marketing-driven approach that steadily increases the traffic in our retail destinations. Well, back in our IPO, we have announced a development plan of 250 million euros spanning over a 5-year period from year 23 to 28. At present, we have concluded more than half of this development plan and is already operating and producing income. And there is another 125 million euros approximately to be invested over the next 3 years. All this bringing us into a gross asset value of more than 750 million euros. So the majority of the remaining of our investment plan refers to the emblematic development of the Hellinikon commercial hub retail park of Trade Estates. More than 75 million euros of total investment.
So as you say, it'll take some time for these new developments to come through and start to contribute to earnings. Does that mean you can still grow earnings in the meanwhile?
Reality is that to date we have executed our development plan faster and bigger than what was initially scheduled and promised. Ahead of us, we have 3 years of development, and it's gonna take some time until those assets will become income producing. Of course, that is on our table, and it will be managed along with the operational growth of our existing assets. And of course, at the same time, we investigate opportunities of acquisitions of already stabilized income producing assets that might contribute to our portfolio and the growth of our company. We should not forget that we have already incorporated 2 new retail parks less than a year ago that are still in the phase of pre-stabilization. So growth opportunities are there. Our relationships with international tenants are all growing. We have a big demand of new tenancies that, of course, enable us to achieve higher returns for our parks. And most important of all, there is a proven overperformance of our destination over competition with double-digit growth still, increasing traffic footfall for the year to date.
I've also got to ask you the other question. There's an awful lot going on around the world. If we had picked up a newspaper in January and read the headlines today, we'd have been shocked. So there is always uncertainty. So if the environment is less favorable for you, what are the downside risks?
Our business model is designed to be resilient across economic cycles. Our anchor tenants are normally supermarkets, home electronics, home furnishings, and in general, the essentials to the family household. They are also supported by value propositions in apparel and footwear. This tenant mix, along with long leases. Our weighted average unexpired lease term is 10 years, high occupancy rates, secure steady growth, and a stable rental income and cash generation.
And you mentioned long leases. Maybe you can say what the average length of a lease is. But I think most of your rents are indexed to inflation. Inflation has been high at various times. Given those long leases, inflation indexation, how confident are you that the current level of rents is sustainable?
I can definitely say that our portfolio is not over-rented. It's true. One of our advantages is that 99% of our rentals are CPI indexed, but most importantly, the rent contracts are linked to turnover rents. So during positive economic cycles, our company is benefiting from the overperformance of our tenants. During negative economic cycles, we have the security of minimum base rents that are fully guaranteed.
So rents are sustainable. What's been happening with valuations? Do you think valuations also are sustainable or even likely to grow?
So our portfolio is valued at an average of 7.80% yield for the past 2 years. I think that level of yield on a comparable basis with European peers of shopping centers and retail parks is on the higher side. Although the evolution of the Greek stock market and most important the performance of the Greek economy, reality is that the yields applied to our valuations remain at approximately 7.8% for the past 2 years. Compared to European peers, I would say that this is quite a conservative level, and I think it safeguards the robustness of the net asset value of our company.
Just turning to the balance sheet, you've indicated that as you develop out the pipeline, the loan-to-value ratio, gearing, will go up a bit. How comfortable are you about that and the company's ability to manage that debt position?
So TRESTATES maintains a prudent financial structure that supports both its organic operation and future growth. Our net LTV will reach 48% by year-end 2026, and 89% of our total debt is fully covered by interest rate swaps that secure an all-in cost of approximately 3.1% for our interest cost. At the same time, our interest covered ratio based on EBITDA is 3.1 times. So we feel quite confident about satisfying our interest needs in the short and medium run.
So you've talked about the growth of the portfolio, the sustainability of rents, and net asset value. On costs, can you talk about your ability to scale up the platform to further improve returns?
Yes, and that's part of our focused and specialized model. We maintain a lean structure of management, and the more assets we add on our platform, the more funds from operation we produce and total returns for our shareholders. Our cost structure is one of the most competitive in the industry, and we intend to continue following this pattern in the years to come.
So if we put all this together, as a shareholder, what should I be looking for in terms of returns? Is it about dividend growth or is it about capital growth?
So if one looks at the performance of the company historically, I would say both. On the one hand, the dividend policy of our company, we deliver 6.9% return for our shareholders for year 2025, giving out approximately 72% of our funds from operation. On the other hand, our company trades at approximately 11 times our funds from operation. So the combination of operational performance with the track record of delivering on time our development plan, I would say presents an interesting investment opportunity for the shareholder that wants the safety of a backup of exceptional real estate asset portfolio with a clear focus on the annual reward of our shareholders plus the value generation for them.
Dimitris, thank you very much. That's been very clear. It's been an exciting 5 years for the company, and it sounds as though the next 5 years will be equally so. So we look forward to catching up with you in the future.
Well, thank you very much, Martin, for the thoughtful discussion. Yes, it's been a great journey for TRESTATES to date, but tomorrow will be an even more exciting journey of more than doubling our size by applying the same principles we have done to date. Full focus on operational excellence, along with total shareholder return that is very satisfactory for shareholders and stakeholders. Thank you very much.